Welcome everyone. Today, we are going to explore the topic, business structures. Choosing the right structure is one of the most important decisions when starting or running a business. It affects how you pay taxes, how much responsibility you carry, and how your business is managed on a daily basis. By the end of this lesson, you will understand the main types of structures, their roles in financial reporting, and how they shape the way a business operates. Choosing your business structure. Let's begin by looking at the different options for setting up a business. The first option is a sole trader. This is the simplest structure, where one person owns and controls everything and is fully responsible for all debts and risks. The second option is a partnership, where two or more people run the business together, sharing responsibilities, profits, and risks. A joint venture is another option, usually created for a specific project where two or more parties work together but remain separate businesses. A company, on the other hand, is a separate legal entity. This means the company itself, not the owners, is responsible for debts, which gives the owners limited liability. Finally, there is a trust, which is used to hold assets for the benefit of others called beneficiaries. Each structure has its own advantages and disadvantages, and the choice depends on the goals of the business. Understanding financial statements. Every business needs financial statements to understand its performance. These statements provide a snapshot of how healthy the business is, and they guide managers while also informing owners and investors. The three most common statements are the balance sheet, which shows what the business owns and owes at one point in time, the profit and loss statement, which shows income and expenses over a period, and the cash flow statement, which tracks money going in and out of the business. Together, these documents give a clear picture of the financial position. The balance sheet, a snapshot in time. The balance sheet is like taking a photo of the business's financial situation at one moment. It lists the assets, which are things the business owns, the liabilities, which are debts or obligations the business must pay, and the owner's equity, which is the owner's share after all debts are settled. Most businesses prepare a balance sheet at least once a year because accounting rules and tax laws require it. This statement is important because it shows the value of the business at a single point in time. Assets. Assets are resources owned by the business that bring value and benefit in the future. They are divided into current assets and non-current assets. Current assets are things that can be turned into cash within 12 months, such as cash in the bank, accounts receivable, stock, or prepaid expenses. Non-current assets are used over the long term and cannot be easily turned into cash. Examples include land, buildings, delivery vehicles, and machinery. Assets are essential because they show what resources the business has to operate and grow. Liabilities and equity. Liabilities are what the business owes to others, and equity is the owner's share after all debts are paid. Liabilities are usually divided into current liabilities, which are due within 12 months, such as accounts payable or short-term loans, and non-current liabilities, which are longer-term debts like mortgages or bonds. The balance sheet is based on a simple formula: assets equal liabilities plus owner's equity. This equation always stays balanced, and it is the foundation of accounting. Profit and loss statement and loss. The profit and loss statement, also called the income statement, shows how the business is performing over a period of time, such as a quarter or a year. It summarizes revenue, which is the money the business earns, and expenses, which are the costs of running the business. By subtracting expenses from revenue, we can see whether the business makes a profit or a loss. This report is essential because it shows managers if the business is efficient and profitable. Understanding revenue and expenses. Revenue and expenses are two of the most important ideas in finance. Revenue is the income a business generates from its main activities, such as selling goods or providing services, and it can also include things like interest or dividends. Expenses are the costs of keeping the business running, such as rent, salaries, advertising, or electricity. A specific expense is the cost of goods sold, which covers the direct costs of producing the goods actually sold. Profit happens when revenue is higher than expenses, and loss happens when expenses are greater. Chart of accounts. The chart of accounts is a detailed list of all the accounts used in the business's general ledger. Each account is given a number for easy tracking, and accounts are grouped into categories like assets, liabilities, equity, revenue, and expenses. For example, cash might be numbered as 110 and accounts receivable as 111. This system helps keep financial records organized and consistent, which makes financial reporting and analysis easier. Journals, ledgers, and double entry. All financial transactions first go into journals, which are like diaries of daily business activities, such as sales or purchases. From there, the amounts are transferred to ledgers, where they are summarized into accounts. The general ledger holds all accounts, while subsidiary ledgers provide more detail about specific accounts. Accounting also follows the double entry rule. This means every transaction must affect at least two accounts, with one debit and one credit. Debits go on the left, credits go on the right, and this keeps everything balanced. In conclusion, we have learned about the different types of business structures and how they impact management, liability, and taxation. We also looked at key financial reports, including the balance sheet, profit and loss statement, and cash flow statement, as well as concepts like assets, liabilities, equity, revenue, and expenses. Finally, we explored the chart of accounts, journals, ledgers, and the double entry rule. Thank you for joining this lesson, and I hope it has given you a clear understanding of how business structures and financial systems work together.